Today marks another pivotal moment in the world of cryptocurrency, as shifting market forces, fresh headlines, and global events combine to shape the digital asset landscape. Before we dive into the deeper stories making waves today, let's set the scene with the latest market pulse, a real-time snapshot of the most influential players in crypto right now. Bitcoin is trading at $117,775, up just $20 on the day. The intraday high has touched $119,288, with a low of $116,953. Bitcoin continues to dominate, though we've seen more than $1 billion in leveraged liquidations this week, after inflation data from the Producer Price Index triggered sharp drops across the market. Ethereum is at $4,450.79, down $87.95. It hit a high of $4,663 and a low of $4,379 today. Ethereum is pushing toward record territory as investors pile in on what some analysts are calling the biggest macro trade of the next decade. BNB is sitting at $825.68, slipping $14.26. It reached as high as $853 earlier, with a low of $813. Binance's native token cooled slightly, even as Bybit EU launched a MyCA-compliant launch pool with Ixion, signaling a regulatory forward push in Europe. XRP is at $3.06, down just 2 cents. It's been trading between $3.14 and $3.01 today. Traders are watching closely as China's AI tool DeepSeek predicts XRP, alongside meme coins like Pepe and Shiba Inu, could see strong gains by year-end. Cardano is at 94.4 cents, up almost 4 cents on the day. It climbed as high as 96 cents and as low as 88. Cardano is on a rally, posting a 5-month high and briefly breaking above the $1 mark. Solana is currently $186.75, down $8.20. It touched $198 at its peak today. Markets around Solana are seeing rapid moves tied to options expiries and a rise in tether minting activity. Dogecoin is at 22.5 cents, up a fraction of a cent. It's moved between 23.2 and 21.8 over the session, holding steady but feeling the weight of broader inflation concerns. Polkadot trades at $3.89, down 10 cents. While news is quiet on DOT today, it's still part of the altcoin rotation as more retail investors branch out from Bitcoin. Polygon is at 23.1 cents, down just over half a cent. It's been range-bound today, but remains a core player in the broader diversification trend among retail buyers. Avalanche is priced at $24.05, up 34 cents on the day. It's been buoyed by the same optimism that's supporting many altcoins, particularly as stablecoins and ETFs push deeper into institutional adoption. And that's your market scoreboard. Numbers that tell the story of a market still brimming with both opportunity and volatility. From Bitcoin's trillion-dollar dominance to altcoins climbing on AI-driven predictions, the crypto landscape remains as dynamic as ever. But behind the tickers and charts, there's another story playing out today. One that shifts our focus from market momentum to market trust. Because even as regulators signal crypto's maturity and institutions make deeper inroads, we've been hit with a reminder that in this industry, reputations can collapse in an instant. That reminder comes from a scandal involving a former Wall Street executive, millions in investor cash, and a trail that leads straight into the casino of internet gambling and cryptocurrency. Richard Kim, once a high-ranking executive at Goldman Sachs and JP Morgan Chase, now finds himself at the center of a federal indictment that reads like a cautionary tale for the entire digital asset space. Prosecutors allege that between 2021 and 2023, Kim raised more than $4 million from investors for what he described as a groundbreaking blockchain gaming startup. The pitch was slick, a platform called Zero Edge Corporation, designed to revolutionize online casinos with transparent, provably fair games running entirely on-chain. Investors were told their money would go towards software development, licensing, and marketing. But according to court documents, only a fraction of that capital ever reached anything resembling a legitimate business expense. Instead, prosecutors say Kim diverted more than $3.8 million into personal cryptocurrency accounts, which he then used for internet gambling on sites like shuffle.com. Bank records also show significant transfers through major exchanges including Coinbase, Binance, Kraken, and Backpack, along with nearly $1 million moved into personal bank accounts or sent to other individuals. When investors pressed for updates, Kim allegedly spun a narrative that the losses were due to a failed trading strategy rather than outright misuse of funds. The detail that makes this case sting even more is that many of Kim's backers were personal friends and longtime industry contacts who trusted his pedigree as a former Goldman chief operating officer in the global foreign exchange and emerging markets division. That resume gave him credibility. It gave people confidence. And it may have made them less likely to ask the hard questions. When confronted by the FBI, Kim admitted that he gambled the money away, knowing full well that it was investor capital and not his to risk. In doing so, he may have violated multiple federal securities and wire fraud statutes, each carrying the potential for decades in prison. Prosecutors are also seeking to seize assets linked to the alleged fraud, including cryptocurrency holdings and any remaining funds in connected accounts. The fallout is already visible. Legal analysts note that while this is a personal scandal rather than an institutional failure, stories like this can ripple through the market, influencing public and political perception of crypto as a whole. Every high-profile fraud becomes ammunition for those arguing that the digital asset space remains unsafe for unsophisticated investors. And that's the paradox. At the same time, the Federal Reserve is signaling confidence in the sector by integrating crypto oversight into its standard supervision framework. Cases like Kim's reinforce the stereotype that the space is a magnet for bad actors. Investor reactions have been mixed. Some shrug it off as the inevitable presence of fraud in any maturing industry, pointing out that traditional finance has had its share of rogue traders and embezzlers. Others worry that the optics couldn't be worse, coming right when crypto is finally making headway in Washington, gaining legitimacy on Wall Street, and pushing toward mainstream adoption. And this is where the tension in today's market narrative becomes clear. On one side, you have the normalization of crypto at the highest levels of finance and regulation. On the other, you have a reminder that the same openness and accessibility that drive innovation can also leave doors ajar for exploitation. Yet, amid the headlines and legal drama, there's another story running in parallel, one that might be even more influential for the long-term direction of the industry. While some bad actors burn bridges, legitimate companies are walking across entirely new ones, raising billions, and in some cases listing themselves on public exchanges for the first time. That's where we turn next, as we explore a wave of cryptocurrency companies stepping into the IPO spotlight, bringing blockchain to Wall Street's front door. Crypto IPO fever has gripped Wall Street, and the numbers are turning heads far beyond the usual blockchain faithful. This isn't about speculative token launches or thinly traded altcoins. This is about established companies in the crypto ecosystem stepping onto public markets, raising billions, and delivering the kind of first-day surges that get even the most traditional investors talking. The rally is being led by names like Circle Internet Group, the issuer of the USDC stablecoin, which went public in June and has since seen its stock price nearly quintuple. Bullish, the parent company of CoinDesk, debuted with an 84% jump on its opening day. Miami International Holdings, another player with significant crypto exposure, climbed 30% after listing. These aren't minor pops. These are breakout performances that have given the broader IPO market a much-needed jolt. The timing couldn't be better for these firms. Bitcoin is up more than 25% this year, hovering near record highs. Ethereum has drawn in institutional flows off the back of ETF approvals and growing DeFi adoption. Stablecoins are now an everyday part of global commerce, from remittance corridors in Latin America to on-chain settlement between multinational banks. Investors are no longer asking whether crypto is here to stay. They're asking which companies will dominate its next chapter. And the IPO pipeline is only getting deeper. Gemini, the exchange founded by the Winklevoss twins, has confidentially filed to go public. So has Grayscale, known for its flagship Bitcoin trust, along with custody giant BitGo. Further back in the queue are privately held unicorns like Fireblocks, Consensus, and Kraken, each of which could trigger massive institutional interest when they make their move. For traditional investors, these IPOs offer something that buying tokens often doesn't. Equity in a business with audited financials, regulatory oversight, and a seat at the corporate governance table. For crypto-native investors, they're a bridge between two worlds, a way to capture upside in the growth of the ecosystem without taking direct exposure to the volatility of individual coins. Of course, there's risk. The IPO market can be as fickle as the token market. Valuations are riding high in part because sentiment has shifted, but a sharp downturn in Bitcoin's price or a major regulatory setback could quickly cool demand. Even so, the appetite right now is undeniable. The Renaissance IPO ETF, which tracks newly listed companies, is up 15% this year, handily beating the S&P 500's 10.8% gain. That performance is being driven in no small part by crypto-linked listings. It's worth noting that this wave of IPOs isn't just about fundraising, it's about legitimacy. Public companies are accountable in ways that private token projects often aren't. They must file quarterly reports, disclose major risks, and operate under the scrutiny of analysts, shareholders, and regulators. That level of transparency doesn't just reassure investors, it helps set standards for the entire industry. When you step back and look at today's three major storylines, the Federal Reserve folding crypto oversight into its mainstream supervision, the cautionary tale of a former banker who gambled away millions in investor funds, and the surge of crypto IPOs bringing blockchain to Wall Street, a picture emerges of an industry at a critical inflection point. Crypto is no longer the outsider looking in. It's moving into the boardrooms, the trading floors, and the official ledgers of the financial system. The challenge, as always, will be holding on to the trust it's starting to earn. Scandals like Richard Kim's can slow that progress, but the discipline of public markets and the normalization of regulatory treatment can push it forward. Whether you're a Bitcoin purist, an Ethereum developer, an altcoin trader, or an institutional investor eyeing the next big listing, one thing is clear. Crypto is no longer an experiment. It's an industry with enough depth, resilience, and momentum to weather storms and still move ahead. And as we close out today's update, the through line is this: the market is maturing, but it's not immune to human error. Regulation is evolving, but it's not a silver bullet. Opportunity is growing, but so is competition. The next chapter will be defined not just by price charts and market caps, but by the ability of the industry to balance innovation with integrity. Because in crypto, as in all of finance, trust is the real currency. And that's our latest crypto roundup for today. Make sure you're following us on Spotify, and we will see you at the top.